Good morning. Good morning, friends. It is Monday, May 16th, and this is the analysis for the Zero DTE service. And so this is the very first scheduled, hopefully well put together analysis that I've done for the service. From now on, you should be able to find it under the Zero-DTE-analysis channel. I haven't decided on what would be the appropriate time to do it, but we're starting today at 9:30 Eastern. I don't know if it's better to do it before the economic reports or after or whatever. Now, there is a process that we go through, and I talked about this at great length in the Discord this morning and also last night, that process is everything with what we do. We are process oriented, we are not goal oriented. Goals are nothing more than waypoints along that process. You should give a shit, give two shits, or not give a shit about goals. They only confirm that your process is working, that's it. Perfection of the process is everything. Our time that we spend on Sundays, the retrospective, is a ceremony that is the culmination of an agile process that happens every week. It's a continuous improvement process. You can think of each day like that as well, as sort of another iteration inside the iteration. So that is what we're all about. We're about process. It is the pathway to your success. Not setting goals, not setting lofty ideas about where you want to be, but head down, perfecting that process. If you focus on that, you will become successful. And that really means that you need to get really skilled at the little things, the fundamental things that we do, like doing this analysis, like understanding your trade platform. If you truly want to be successful at this, if you want to turn this into a business, it really is a business, regardless of whether or not you have another business or another job or whatever, you are investing serious amounts of your own capital, your hard-earned capital, and you're putting it to work, and you want to do it the right way. You do not want to squander it. It's better to not put anything out. Better not to put anything out there until you feel a little bit more confident with your process than just jumping right into it. However, with our strategy, it allows you to take those baby steps to get into it without really risking a lot. And so that's one of the beauties of this strategy. So, first of all, I want to make sure that everybody is actually seeing me and hearing me and all is cool. You can place a comment in the chat box. I have a new streaming software that will allow me to display those comments on screen if I so choose to click on one of them. But that would be great if you can just say hello or just announce yourself in the chat. As a matter of fact, that should be part of our process. When you get engaged with the analysis in the morning, I want you to actually put something into that chat box saying, hey, I'm here. I'm ready to go. Or, you don't have to say that. You can say whatever the hell you want. Excellent. That's what I like to see. Fantastic. That's great. So today we're going to start fresh. We're going to do an analysis with a blank slate. And so I'm going to bring up the volume profile, and we'll get going on that. All right, so what I have here, let's see, I'll move the microphone over closer to me. So here, let me just do this before I do this. This is going to, let's see, how do I get rid of this? Preview mode, default scene. Oh, okay. I'm still getting used to all of this. All right. So what I'm going to be showing you is that I'm going to be working on this over here, right? All right. So I always start with as much data or span of time as possible when I'm doing my volume profile analysis. And I want to capture all the major nodes and then drill down in time and see if if anything needs to be added to or adjusted. So here we can see that we're in a very strong downtrend, very volatile, lots of pullbacks, very indicative of a bear market where you have these bullish rallies within the bear market, very strong rallies that are usually met with immediate rejection. Sometimes not so much, like the one here in early March that went up for a while and then it got rejected. But then we had other rejections, like last week we had a big morning, all-day rally and then a rejection, and on Friday a big rally and now it looks like maybe another rejection. As you can tell, I'm still suffering a little bit from my cold, but I'm at the end of it. All right, so what I do is I will typically start with rectangles and outline the major nodes, and then just bring them over to where the representative piece of price action that created that node. Now, of course, this node here was created with two pieces of price action, one that is recent and another that is way in the past. As a matter of fact, a little over a year ago, but it's still significant. All right, the edge of that node where price falls off at its steepest is where I put the upper and lower bounds of the box. And then I'll do now I might make this red only because it's that was the color that was showing at the time, but maybe red's a good color for actually red's not a very good color because you want something that will cut across price and you can see it easy. So I usually make that yellow. Let's make that yellow. And I'll do the same thing for other nodes. You can see there is definitely a node there, and that node is kind of punctuates the big gap that we had here. All right. You don't have to be too precise at first, all right? And I'm only going to get the few most prominent nodes here first, and then we'll zoom in a little bit, just to give you an idea of what I do. The next thing that I do is I want to identify the volume wells, the low points in between these major nodes. Now, some of these nodes, because they're further away, I'm just going to make them a little less prominent, maybe make them only 2 pixels wide. Now, these are concepts that I did in the volume replay course, too. I talked about using different colors, different widths of lines, and so forth, so that when you're zoomed in, you see these artifacts that you created in a much larger time frame, and based on color or width or whatever, you can tell whether or not what kind of level of prominence that you think it has. But these are all things that you'll develop on your own. All right. Next thing is to create these horizontal lines that show the lowest point in the volume wells. All right, and I use a horizontal ray for that. Now, the low points in this well are kind of hard to define, but I would say it's right about here. That's one low point. And then there's another that is right about here.
New visitor.
Right, and you'll find that, I just draw those sort of almost haphazardly, but they're fairly well aligned. And then when we zoom in and you start seeing price move up and down, you'll see that they will respect those lines, or apparently appear to respect those lines. All right. So the next thing that I'll do is I'll tag these nodes with what I think is the most likely to be visited next. And here, this is kind of up in the air. Are we most likely to visit this tiny little node here that's sitting in the middle of this huge volume well? Or will we go down to this other node that we've seemingly came down and visited very quickly and then bounced out of? I would say that the bigger one has more prominence right now, only because because of the downtrend, its proximity and its size and its newness, right? This one also is fairly new, but it's not quite as prominent, so it may not have the same gravitas. It's kind of up in the air, so I'm going to call it a kind of a tie, but that's okay. So I still have to pick something, so I'll call this one T0. And really the only reason for doing this is for communication with you guys. When we're talking about these nodes, by labeling them, we are talking about the same thing, right? That's important. That communication, that consistency of communication is extremely important. And each day I will update them. They'll usually pretty much stay the same. But if I feel like price now has moved and another node now becomes T0, I will change the order. And then we'll call the one up further T2. All right, so we've almost completely marked this up. I sometimes will also put in a couple little things in here, like I'll call this volume well number 1, and I think that down below here is probably another volume well, so I'm going to copy and paste this one and bring it down here and then call this one number 2. Again, just so that we have something to talk about that is in common. Now, also considering that there's probably another low point in here, I would say it's right about here. I guess you could argue that it's right here, but I'm going to say right about there. All right, it's almost right down to where price was rejected. Now, it could be that it is exactly where price got rejected. We just may not have enough data in here. So if I bring in more data, I may see that that is, in fact, the right place to put it. So it's hard to tell. So it actually looks like it's probably closer to right here. Right? So now that rejection makes more sense. You see that? The time frame is okay. Let me do this. There is a question. Add to the broadcast. Does that add to the broadcast? I thought it adds to the broadcast here. Remove from the broadcast. Add to. Oh, there it is. It's way over there. That's not big enough. We need to make it big like that. What time frame are you showing? All right. So now we'll go back to here. Now, I'm showing, I mean, this is a daily chart, but the time frame is not relevant. It's only relevant in that, can I fit enough bars in the in the chart, and do they look, are they easily identifiable? So daily seems to work best. But all that really is relevant is the range of time that I'm putting up there. And so in general, what I'll do is I will go from a large range of time to encapsulate all of the price data that I think I need in order to do the analysis. And then I'll come down to something that's maybe 1/3 to 1/4 of that. So if this is daily, really the only option I have then is to go down to actually 1/6 of that, which is 4 hours, because that's what they give us on the chart. So my next step down would be to 4 hours. All right. And then I'll usually click auto here to fill up the screen. So I usually go from daily to 4 hours. Now you can see how much data is actually showing. So now really the only relevant time here, we have to decide, there really isn't much more beyond that. So really the only relevant time is between like about April 20th and the present. I suppose we could go all the way back here, but there really isn't that much. So really, 4 hours is good. Then I'll go down to 1 hour or to 30 minutes, and then down to maybe 5 minutes. There's no additional analysis that I have to do at those times. They're not significant. They are just those are my waypoints or stopping points. My the clicks on my magnifying glass, I guess you could say. All right, that's all it is. All right, so we can get rid of that. Hi, Ernie. Today is the 16th. Did I say it was something different? So, anyways, so now here we have our profile. We can zoom in a little bit more. We can see a little bit more. Maybe go down to 1 hour. And of course, the volume nodes that we drew in the large don't appear to always line up correctly with these more virgin volume nodes, I guess you could call them. But that's okay. They will have some significance in themselves.
Returning visitor.
Oh, Jesus, that's got to be fixed. But anyways, let me just fix that. Okay. So the newer volume nodes really don't have as much significance as the older ones or the more prominent ones. They have some, and this is the fundamental mistake that I think that most people make with doing volume profile analysis. They tend to focus a lot on the session volume, which is really just giving you the last few days of volume. But price isn't really following those cues from those previous sessions nearly as effectively as it is for the much larger nodes that have been created over time. And so I find that is a fundamental flaw in the way most people are treating volume profile these days. And I think that it's been proven out actually quite effectively in our analysis. All right, so what else do we have today? We do the volume profile. Now what I'll typically do is I'll create a screenshot of this like so. And then I'll place it in our Discord. Just get it over here. Put it in the analysis channel. There we go. The next thing that I'll do is I'll take a look at the energies that are coming into the market. What is the state of those right now? So let me get back to this. And then we'll get back. Let's see. We'll change screens here.
Returning visitor.
Oh, I know where I wanted to go. I wanted to go to channel 4. Like that. When I go to channel 4, we have Forex Factory. It's my go-to for looking up economic reports and what is happening in the day. Let's we'll refresh that. See what we have. All right. So we have the Empire State Manufacturing. That is a prominent economic report that we look at closely. Huge miss. This is a big miss when you miss by that many points. So that is definitely weighing on this market. A Fed governor has already been speaking. I don't know what he said, but whatever he said, let's see, it'll probably tell us what he was supposed to talk about. Due to speak about Mortgage Bankers Association Secondary and Capital Markets Conference. So most of these Fed governors that are coming out here are on kind of like tour, and they're trying to support whatever was said or the conclusions that they came in the last FOMC meeting and rate hike. So once in a while you get a rogue member that will come out and with their own ideas, and that will kind of upset things, and then they'll have to all regroup again and then try to smooth things over. But they're universally lockstep, which is kind of interesting because in terms of their performance, they are, in my view, completely incompetent because they've gotten nothing right in the past, well, decades, for crying out loud. They are the cause of almost every recession, and then we look at them to help fix the problems that they create. And I shouldn't say that they actually create the problems. They are tools of our government. The government basically gives them the directive. The government spends the money, and then the Fed must then monetize whatever money that they spend, and then create additional funds to be able to support that. So all that goes into the economy, and that's what's causing inflation. Of course, they will never admit to this because that will really spell out their own ineptitude, their incompetence. But that is the truth. I mean, it's that is what is causing inflation. It's not the pandemic or the supply chain or any of that other crap. I'm sure that those things have some effect, but all of this stuff started well before any of that. And the food shortages, the inflation is all because of just, well, the $9 trillion that they've spent in the past year. Adding $9 trillion to a $20 trillion economy has to have significant effect, and we're all feeling it right now. So anyways, Empire State Manufacturing, if you want to, I would say that for the most part, you should be very in tuned to all these economic reports. You should understand what they are, what their effect is, how they're generated, whether they're leading or lagging indicators. All of these are very important, and how they fit into the context of the day. You may ask, well, why do I need to know all that, Ernie? Well, it's sort of like the same thing if you're a professional at anything. Sure, there's the fundamentals that you need to make sure that you are 100% on top of, but then there's all the other nuanced plays that make you the professional that you are. This is just one of those things. You need to understand the economy. These energies that are coming in are directly affecting the analysis that we make in terms of determining where price is going to go for the rest of the day. So the more understanding that you have of this, the better. I know it seems daunting, but use your process-oriented self and figure out a way to develop a process to go through these and educate yourself. There's a really great site. Now, you can learn and glean a lot just from Forex Factory by going to the little doohickeys over here and then reading somewhat about why you should care about this and what its effect is. But this is all trivial information, or I should say it's not trivial, not trite. It's important. It's summary information, but it doesn't really tell you everything that you need to know. What you need to know is really you have to go back and find out where this report emanates from, what the actual report is, what's the website where it comes from, and learn from it there. And, if you have to study about it more, you study about it more until you really understand it. Then look at its historic performance and its implication and how it has potentially affected markets. You should know that there's probably 30, maybe 50 indicators that you should have at least a cursory understanding of. And here's a good site where you can find out a lot of that information. It's called tradingeconomics.com. They also have a calendar, but they also have really great, more in-depth information about each one of these reports. So if we went to today's calendar, for instance, that's yesterday's. Can we get to calendar? Let's see. I wonder why it doesn't go there. On Monday, Tuesday. Yeah, I don't know why I can't get to Monday on this, but anyways. If you wanted to find out information about any of these particular things, you can go here and you can click on it. You can get quick graphs and so forth. It's a good resource. I also use Econo Day. You should look them all up. Anything that you can find out that's going to help you gain an edge, that's what you should be doing. That should all be part of your regular process. All right. All right. Let's go on to the next thing. So here we have some negative energies coming into the market for sure. And of course we can see that in the chart. Next thing is I probably want to look at the VIX. And where we are on the VIX. Now this is kind of interesting. The VIX has actually opened a little down, which I don't understand, considering that the market is down. Doesn't make a whole lot of sense, but that's, whatever. We can zoom in on our chart, and so I look at this VIX. What I'm really looking for is where we are in terms of our Goldilocks zone, which is between 17 and 34.
New visitor.
Let me bring that over. So you can see how I have the VIX set up here and the lines of demarcation, because over my experience has shown me that our best performance happens between these areas of the VIX. And then I like to break that up into three areas, three primary areas. I call it the upper, middle, and lower third. So if I were to draw a rectangle, it'd be, something like this. So you'll often hear me talk about the upper, middle, and lower third. So when I'm talking about that, that's what I'm referring to, approximately. All right. Generally, when you have a cluster like this in the upper third quadrant, that's a very unusual situation. I guess one could argue that happened over here as well back in mid-March, but it looks a little bit different to me here. It looks a little bit more organized. And when I see something like that, that to me looks like the potential for us to go much higher. Or drop straight down. But I don't think that this is going to happen this time. I don't think that we're going to get a big rally all of a sudden. The market seems to be getting progressively worse. And they're doing whatever they can to sort of keep things together. All right, let's go to big head, back to me. All right, so the next thing that we'll do is we'll take a look and start creating some scenarios. So we'll go back to price. And take a look at what we have here. It seems obvious that we're sort of channeling between these two LVNs, the two green lines, which is kind of interesting because I drew those based on that daily chart, and now it seems that it's respecting both of those lines, which is very interesting actually. And in the meantime, it's creating this sort of local newbie child node here in the middle. So we had this big rally on Friday, which most of these bear market rallies, like we had after Jerome Powell's speech here last week, and now this week. Actually, that would that have been last week or the week before? But anyways, we have this rally. It's usually met with retraction of that rally or rejection of that rally. So my best guess here is something like this: that our first move is likely to be into this volume node. Now, the market's still pretty heavy. I don't see any positive news on the forefront here, so I'm going to say that we're probably going to come down and test this LVN again. So that's my first scenario. Second scenario is that somehow the market wants to rally again, but I don't think it's going to rally much. I think it's going to maybe do something like this, maybe come up to here. I don't think it's going to venture off too much further than that, and then probably come back down. Those are the scenarios that I see today, because the energy still is really moving to the downside. There's significant. Now you could also look at this as sort of a new volume well, but it's also punctuated by the fact that there is a long-standing node here as well that's going to provide some resistance. And so I don't see us breaking through that. Breaking through that would mean a substantial move up into this area. And I just don't see any positive energy that would bring us up there right now. There would have to be some kind of major change in economic conditions or a change of path of the Fed in order to get us up there. Right now the energy seems to be down. There may be some minor rallies, but they're all going to be met with further downside. And that's just the nature of a bear market. All right. So those are the scenarios that I see. So what would be proper placement? Well, in order to do proper placement, we have to get a better idea of what is the expected move for the day. And we can do that by looking at our options chain. And this is the E-mini. We're going to be trading the SPX, so I'm going to bring up the SPX instead. Somebody trying to talk?
Yeah, Aaron, can you hear me?
How do you get on? I don't understand that. Can you please text your message? Now, how did that work? Oh, I know what it is. That's because I have... yes, that's because... I'm sorry about that. That's because I have Zoom open at the same time. So, whoever that was, please come back on. You can ask the question. But your volume isn't very good.
Sorry, can you hear me? I'm just saying your screen's not displayed.
Yeah, I can just barely hear you.
Your screen's not displayed.
Yeah, that's because I'm not broadcasting on Zoom. I am broadcasting on YouTube. If you go to the Discord in the analysis channel, there's a link there. So, does that mean that all these people are on Zoom and looking there? Oh.
Returning visitor.
Oh well. Should have made that clear. There's another area where I can improve on my process. All right, so let's take a look at what we have here. So, a quick cursory look at the difference between the calls and the puts. We'll show that from at least from the beginning on the open interest side, we can see that it was almost even. Maybe even a little bit of an edge to the calls. Right, because we had this level at 40.25 and at 40.40 that all seemed very strong, and then of course at 40.50 on the call side. And on the put side, we have 4,000, 39.90, and 39.75. But then way further out, there's some big bets being made out here at 39.50. And right now, that seems to be the leader in the total volume. That's the volume leader, at least, for, I guess, maybe by the end of the day or whatever. But that seems to be the level that the market is shooting for. We have an expected move of about 46 points. You got to take that expected move with a grain of salt. It's really just a way to roughly gauge how much the market is likely to move. You got to remember that it's really based on a normal distribution, on an average, based on the amount of range that we have in pricing right now. This is what the market thinks that is potential beyond that. And in any one day, it doesn't appear that it will always match what the expected move is. Sometimes it will. But over a long period of time, when you look at the outliers and then all the other distributed moves in that time, it may average out to that. So to look at that and say, oh, that's how much we're going to move today is just a misnomer. It doesn't mean that's what we're going to move. That's an average. You cannot trade to averages. You can only use those as sort of markers for your further analysis. So what I would say here is that we're getting a little bit of a bump up here, but in general, it looks like the areas that we need to be concerned with are 4,000 and 39.50 on the put side, and 40.40 and 40.50, which is a pretty significant cluster. It seems like the on the put side, they're really gauging for this 40-50 mark. So let's take a look at where that is on the trading view. So there's about a 5-point difference between the E-mini and the S&P, so I'm not going to bother going back and forth between the two. But 40-50 is really up here, right at the upper bounds of where I've put this, right? The S&P is about 5 points higher, so it's right about there. That seems to be where a lot of call action is. All the put action is more clustered around 39.50. 100-point difference. So 39.50 is right in here. Right? So those are your two areas. All the put action is here, all the call action is here. So which way should we go? We're sort of sitting here going sideways between the two areas. I would say that in general, that the odds of us going to the lower end are better than the upper end. We had this rally, it made no sense, which is indicative of a bear market rally.
New visitor.
We've come down a little bit, we're getting a little bit of a relief here. I don't know if there's been some kind of news item or whatever that is causing that. Could be. I haven't seen anything. Maybe we can go and check our news. So what I'm doing now is I am going back here. I like to get a general feeling for what news is coming through. I just scan the headlines. Let's see, stocks decline on growth concerns. That's referring to the economic report. Stocks open lower. Portfolio manager predicts market bottom is close. Let's see, world's largest company. Let's see, U.S. recession as high as a U.S. recession risk high as rates rise. Moody economist warns. I don't see anything positive here. And China disappoints. You know, the market wants to believe Jerome Powell that he's going to engineer some sort of soft landing, but I don't know why they listen to him so closely. He's been an abject failure. Everything that he has done, everything he has predicted has been just, not just wrong, monumentally wrong. Yet that's what they do. So, you know, you really can't. You can't discount the will of Wall Street. That's what, if they want to do that, they want to do it, no matter how much we think that they are right or wrong. But I think ultimately this will prove out that the market is going to go down. Ultimately, we have all these little things. I think what we're presented with today really is kind of an opportunity to put on a higher probability trade. So for instance, if we chose the 39.50 as our mark here, as we're moving up here, that gives us the opportunity to put on a better risk to reward trade. And so I would like to take a trade if we get near the top of this little channel that we've created. So if we could get up here, maybe up to the 40, 25, 20, 40, 30 area. That might make a good trade if we can put something in here and center it on 39.40 or so. So let's see what that looks like. So let's take the 39.50 area. Let's see what a butterfly looks like there. All right. So a 5 wide butterfly is obviously not what we're looking for, but let's start with 20 wide. So 39.70. And 30. It's a little far out, you know, but it's within the range of the expected move, and I think we can probably get a good risk to reward here. So with 20 wide, that's a $2,000 potential profit minus the cost of the trade, which is $150. So 1850 would be our max profit at about let's say a $150 cost, and we could probably get it lower. But let's say it's 150, right? So 150 divided by 1850 is a, I'm sorry, 1850 divided by 150. It's about a 12 to 1, a 1 to 12 risk to reward. Those are pretty good odds. We could probably even get better. I just don't think that the upside is the right move. Now I could be totally wrong, but this strategy is about. Let me just switch back here. This strategy is about taking asymmetric risks, right? We're not sitting here trying to, kill the market, trying to figure out how we're going to extract every penny out of the market. We're looking to grow our accounts in a safe and reasonable way and use these principles of asymmetry to work in our favor on the final day of expiration. And if price were to just move down 10 or 20 points as the profit curve starts rising, we may not have to even get too close to this profit tent to profit. So for instance, if we move down to, say, right about here, which is at about 38.90, right? 38.90 on the mark on that 38.90 is right about there. So even if we move down to, say, I don't know, 39.50, let's see what 39.50 looks like. Well, 39.50 put us right there. Oh, I was looking at 39.80. 39.80.
Returning visitor.
Let's look at what that. I'm sorry, I'm getting a little confused with the pricing here. So 39.80 is right at the bottom of this LVN, or right about here. So that's like the outside edge of the butterfly that we created. So this is the profit zone that we're really looking to grab. Somewhere inside here. I think that's very reasonable. And something like that. All right. Let's see, Chris. Hey, let's see. I'm gonna get your comment up there. So hold on a second, because I got to make use of this platform here. Hey, Ernie. Regarding the expected move per option chain, it has been understated since January 1st. We've had a discussion about how we should use the expected move before and since then. I've kept tabs on it, and the actual daily range always exceeds the expected move range every day since January 1st. Yeah, and that's basically what I said. It's usually not what you expect. There wasn't a single iteration where the actual market action stayed within the stated expected move. So we should expect more. That's great. All right, hold on a sec. Oh boy. So, again, a good point. All right, so I think that a sound move then today would be a very low risk trade and expecting to come within the area that I've outlined here. All right, that seems to be the sound trade. You know, don't spend a lot on it. If you put a position on right now, put on a minimal position. If it goes against you and you can get a better price at another, if that is within your risk tolerance or capacity for risk, add another to bring your cost basis down. And then during that day, if we start moving down here, you could end up with a very nice profit. Are there any questions? I have to tell these guys. There's some glare on your screen. Huh. All right. Seems like price might rise. Add to the broadcast. Seems like price might rise before it drops. Right, so that's my point, Tim, and that's exactly right. What I'm saying is that, you know, we pick that put side of the chain and wait for price to go back up to the top of that channel that seems to be created inside of these LVN lines. Right? That seems to make the most sense. So let me know, what do you think of this type of analysis in the morning? Is this something that you would like me to do every morning? So Nicholas D'Souza is asking, so we are trading the SPX, not the ES. I'm not telling you what to trade at all. But you know, the SPX makes more sense. We do all our analysis in the ES because it has volume. And if we're trading during the day, then it only makes sense to trade the SPX because we get a better price for it. In other words, the commission's much lower, the liquidity's a little bit better, and you don't have to put on as many contracts to get the kind of leverage that you want. So for that reason, I would say that the SPX, if you're going to take a trade during market hours, is the superior asset to trade. So let me make that clear again. I'll always be doing the analysis in the ES and then usually do the trading in the SPX. All right, so it seems like most everybody is definitely like this form of analysis. And I agree that the written analysis is good as well. here's my my challenge is that it's hard to do the written analysis while I'm trying to conduct this kind of broadcast. I'll have to do it when I get back to it, when I shut everything down here, and then of course I have all the other stuff that I'm doing too. And I know Mama Cash prefers it written, so I'm gonna have to think of how I might do this. Maybe I'll provide an early morning written analysis, and then once I've completed that, then do the broadcast. That way there's something already written, and and then it just the broadcast is speaking to that written analysis. How's that sound? Everything here is also a continuous improvement process. This entire service has been improving since day one by design, right? So that's the whole purpose of that retrospective, that we take everything that we've done and figure out where we're going to go. And so this entire service, like I said, has changed iteratively every week that we've been in operation. So yeah, we'll probably start a little earlier. This is the first one. No, I get it, Mama Cash, that what works best for you, but I have to try to strike the best balance. And I'm thinking, again, probably the best thing to do is to do an early morning written analysis like I used to do, say at around 7:30, write it all up, do all of the screenshots, etc., and then follow up with a video broadcast that goes over the analysis. So that's what I'm going to do. But this is the first one, so that's just the way it is. Cool. So it sounds like you all agree with that.
Returning visitor.
All right. Excellent. And, as I do more and more of these, they'll start getting better produced, tighter, more condensed, probably only, instead of taking an hour, it will only take maybe 20 minutes, etc. Well, I just said that, Joshua, they could be shorter over time. Have one video for reference on Discord, and yeah, it's going to be shorter. This is the first one. We're learning here. All right. Cool. That's all I've got to say for now. I feel uncomfortable about taking a trade on the bullish side, even if it does move up there. I feel like it's going to move away from there. So I would prefer putting on a relative long shot for very little money. And that's it. Now I just have to figure out how to actually end this broadcast and say thank you very much. And if you want to re-watch this, it'll be in the analysis channel. All right, take care. I'll be on the Discord.